Hey, good afternoon, everyone. Thanks so much for giving me your time. Um, this is Mark from Right Line Trading, and I just want to start with our mandatory disclaimer that all signals and trading opportunities provided both orally written or electronically that are disclosed to subscribers or visitors are for educational and demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures, forex, or stock markets, nor for any profits or losses that may be incurred. Participating and trading in the forex, futures, and stock markets may involve substantial risk, and I'm sure everyone understands that you can lose a significant amount of money. Always do a careful consideration of your financial position. Do your own due diligence. Consult a financial advisor. And those of us at Right Line Trading are not registered financial advisors. We're not licensed commodity trading advisors at the current time, although I'm looking to take my Series 7 and change that. Now with that, I'm going to drop the slides altogether and move over to a chart. What I want to show you is a standard chart of volume and how oftentimes you're going to see this is just a standard range chart. We could look at time or tick. It doesn't make any difference. And how oftentimes we're going to see an analysis of time, based on volume spikes that occur, and this analysis is done retrospectively. So you're going to get a spike underneath this candle and a spike in volume underneath this candle. And an analysis is going to be done based on this volume, based upon this volume spike. Now, volume is a very, very important parameter. And, we know that there is all kinds of other ways to look at volume in terms of market profile, volume ladder, things like that. But the raw data that's interpreted is really also very relevant and can really provide you with really important information on a trade. But this provides you with no information. And I don't want you to ever be misled if you ever see a volume chart like this, because this does not take into account how long it took this candle to form. Now, you can always right-click over it. It's going to open up a little box that's going to tell you how much time it took. But that's a labor-intensive, slow process. And this spike in and of itself represents nothing. It may be that the power of the bulls and the power of the bears right here are equal, and it took a long time for this candle to form. The same thing here on this whole formation. Volume is higher, but we don't know if this was just a slower market. And volume simply accumulated underneath each candle. So your standard volume analysis is really not going to be of any significant value whatsoever. So what I'm going to show you a combination of indicators that are going to provide you with a really significant advantage in trading. We use them, and they're going to really help you. Now, what I want to do is just go back to my slide deck and bring that over. And just start from the beginning again and rotate it around. And I talked about how, individual volume spikes underneath a candle don't really provide us with any relevant information. What we really want to know are how many contracts that are crossing per minute or per 30 seconds or per 2 minutes as price moves. So what we've created, again, same example. Here you have up volume, here you have down volume or selling pressure, it doesn't really give you any relevant information as to whether or not the market's going to turn, whether you're going to get a continuation. All it simply tells you is that a lot of volume accumulated under this candle. And again, you have to look at time and check it out. So if you're trading range, you're trading a tick chart, these are all the things that you have to look at. Now, here, what we've done is we've created an indicator called the volume hammer. Now, no matter what the speed of your chart, whether you're trading an 8 range, 13 range, 21 range, whether you're trading a 5-minute, a 10-minute, a 15-minute, it's all irrelevant. This is going to spike depending upon how you set it. And you can only look at this data in real time or in market replay because the volume hammer is moving it. In this particular case, it's tracing out a line every 60 seconds. And it does it in real time. So you can see this spike of volume accumulating in this 1 minute interval. In the second minute interval, you can see it drop. But what's important to see is that volume spikes right as this candle pulls back to support. And this volume spike gives this trade a push to the upside. And remember, this has to be assessed in real time because this is going to move off this candle, because this may be an 8 range or a 377 tick, or it may be a 3 minute, and this is assessing volume every 1 minute. And so your chart's moving at one speed, and the volume hammer is moving at another speed. The only thing you care about is what it's doing at the right edge or how it performs in market replay, which is where I got these slides from. The spike helps guarantee the continuation off support. And here's the same thing. Now here you're moving in an area of consolidation. Price is moving sideways. I really like to trade out of consolidation. But what you want to know is when is there going to be a break in consolidation? And most breaks in consolidation come with a spike in volume. And you can see now it may be a slow forming candle. That's irrelevant here because this is moving on 1 minute intervals. You can see that green line start to head up as the candle sits there. And then volume continues high for another 2 minute period. So it tells you there's going to be a break of consolidation and that the consolidation is going to continue. And the same thing happens here. You're in consolidation. You get a spike in volume on a 1 minute time frame, which is irrelevant of the chart speed, and you get a break out of consolidation to the upside. This is volume really confirming that you're going to get a move to the upside with follow through. Well, here's a terrific trade to the downside. Again, price is moving sideways. It doesn't have to move sideways. It can help guarantee a move down, but you get an enormous volume spike and a continued press of volume. This is 1, 2, 3, 4, about 6 minutes throughout this whole consolidative period. So you know that you're going to get a break out of consolidation. And consolidation almost always breaks in the direction of the trend. Here you can easily see that the 50's down, the 15's down, the 15's crossed the 50, and price is going to head to the downside. Same thing here. Spike in volume, but you can't trade. I mean, you've got the 15, and this is a 15 exponential of a 15 exponential. It's a proprietary line that we created. You can't trade into resistance. But price does move up, then sideways, then there's the spike in volume, not quite as high, but still a nice push, and it takes the trade up. So as a confirmatory signal on a trade to enter or as a continuation signal, it's really invaluable. Now you're going to get these, and I'd say between 70 and 90% of these moves to the upside. It also will signal you in sometimes just a little bit early on institutional volume. You'll see it just skyrocket, and price lags just a little bit. And if you're in a position where you're going to enter a good trade, you can take the trade. And you know that you've got big volume behind you. Now, the thing is, I took off the units on purpose because once this goes up high, it starts squeezing this down a little bit. And I don't want to get caught up on this. I just want to get caught up on these spikes. I mean, I just really want to emphasize the volume spikes above average volume. Here's another example. There's a spike. You can't trade this. It's just a move up. Can't trade this. It does move up, but you're moving up into resistance. Here's your trade. Sideways. Looking for the long break. You get the spike in volume right here, and then that higher area of volume continues, and it pushes price to the upside. Now, another indicator, and these indicators go together, and they kind of, in a sense, they do work complementary, or at times they can work individually, but as a duo, they're really, really powerful. Is our consolidation indicator. Now, the indicator is going to plot out for you when there's sideways movement, and it doesn't matter what you're trading. Hopefully I'll have time to bring over a live chart, and I'll show you the consolidation signal. You can take it on a time, tick, range, Unirenko, any kind of candle. You're going to always get a consolidative pattern. We'll give you the inputs. You've got to get 8 candles that move within narrow range. And what makes consolidation so powerful a setup is that it traps a lot of sellers and a lot of buyers in a narrow range. So when consolidation breaks, it's going to be stopping out all the traders that are caught in the counter trend direction. Everybody who's positioned long here is hoping for a move up. Everyone who's positioned short here is hoping for a move down. Now, consolidation also almost always breaks in the direction of the trend. Now, you're going to get consolidation patterns where there is no defined trend. There's no trade on that break. But when there is a defined trend, you're almost always going to get the break at a consolidation to the downside. And it's going to be pushed out by 2 forces. One is the addition of new short contracts, hopefully by institutional money, because they created this downtrend. And 2, by all these traders who bought getting stopped out. They're going to have to sell their contracts in order to get out of their positions, and they're going to help launch these trades down. And sometimes you get explosive moves out of consolidation because you stop out so many traders in the counter trend direction. It blows through consolidation. Here's another example of consolidation. I just chose to demonstrate it on a range. Excuse me, but it does not matter. Now, in certain instances, when there's a multi-time frame alignment in trend, it will actually give you an entry signal. As you see right here, you've got a green up arrow. That is not a green arrow that I created or I put there. It's a green arrow that's signaled by the software, and it allows you to get into the trade early. It's predicting. You don't have to wait for this candle, which breaks consolidation. You can get on this candle because it's aligned on multiple time frames to the upside. You're going to get the signal, and it's going to foreshadow the break, and you can get in earlier. You're not going to get that many of these on a break of consolidation, but when you get them, they're great signals to take. And here's another. Now, I formatted this a little bit incorrectly. Instead of getting a triangle, the software was creating a dot. But this red dot predicted a break in consolidation right here. And you can see it was wrong. It came on the next candle. But you should not have been stopped out. You're still in the consolidative pattern. Does not break consolidation. The next candle, it fires out to the downside. So I wanted you to see that it's a really great signal, but it's not perfect. But it's almost always going to call the break and the direction of the break. But the direction of the break we already know. We're in a defined downtrend, and we're almost always going to break out of consolidation to the downside. And we've got this nice channel. There's a lot of candles in here. It's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 candles in this consolidation pattern. So we got a lot of buyers caught on the long end. And when they get stopped out, they're going to really push this thing down. Now, these are very low risk, potential high reward trades. And this is what a day trader or a swing trader is looking for. They're looking for entries on stocks, futures, or the Forex market in which they take little risk and the potential for big reward is there. And this is going to help define that. Here's another example. Now, this is not on range. I believe this is on ticker time. It doesn't make any difference. I just wanted to show you that on a different type of candle, you still get the consolidative pattern. The consolidation indicator only looks at the candle bodies, not at the wick. And the break of consolidation, which is a 2/3 candle body close above the upper line, gives you the move to the upside. You get a nice long trade here. These could be minute bars, hour bars, daily bars. The time frame is irrelevant. So the magnitude of the move is unknown. This pattern you're going to see on any time frame. Here's another example. You have a defined trend. You're above the 50, 15's above the 50. You'd like to have the 50 green, but it's rolling. It's yellow. And you get the break right here. You go up into consolidation, up again into consolidation. Now, depending upon your risk tolerance, you're going to get a pullback to support and then a long move to the upside. Here's just another example. Now, here are two consolidative patterns. I mean, if the market is moving sideways, unlike today on the NASDAQ, where it was like a hurricane, just up and down, we didn't get many consolidative patterns. But when you do get a lot of sideways movement, you get great entries. And the move, if you go long on the break, and then when you move into consolidation, you don't exit the trade. Because the break of consolidation is almost always going to be again to the upside. So you hang in there and hope that the consolidation, it's going to form early, but it's only going to print when it's caught 8 candles in this narrow range. It prints, you've got it, and then you're just going to wait. You're still in the trade, and you're going to wait for the next break to the upside and get a really nice move. Again, the most important thing is it's an extremely low-risk move. Now here you get multiple long signals, which is really unusual. But you can't take this trade or this trade because you must have the 15 crossing or above the 50 to define that long trend. So this is your entry. Now if you took this entry or this entry, you didn't get hurt. But these entries are associated with a lot more risk. And you don't want to deal with that risk. What you want to do is take this low risk trade with the 15 just crossing the 50, 50 and 15 are green, get the long signal, and you do get the break. Now what we're going to do is we're going to combine the two. We're going to combine the volume hammer with consolidation. Now, it stands to reason that if you got a lot of traders getting stopped out on a break in consolidation, that it's going to cause a spike in volume. And that spike in volume is simply going to confirm the break. Now, this first spike in volume, nothing happens. This second spike, here's your break. 2/3 candle body close below this line and the move down. Now, this is a counter trend trade. It's a break in consolidation. But we're in Florida. That's thunder. And we wouldn't take the counter trend trade. But I just want you to see that the volume hammer confirms the break in consolidation and can potentially give you this trade. I personally wouldn't take a counter trend trade, but I wanted to show it. Here again, you're moving sideways, you get the spike, and you get the break. And down you go. Now here, you don't get a consolidation pattern because it's just not narrow enough and there's not enough candles. But you are moving sideways. And you do get the volume spike and price breaks to the downside. So you've got to look at market structure and associate that with a potential great entry and look for a spike in volume at a place where you're looking to enter the trade. Here at a consolidation, it's a well-defined entry on the break. Without the consolidation pattern, it can still give you great entries. Here's a signal long with the spike, which makes this trade ultra low risk. To take one tick above the close of this candle, even though it's still in consolidation, and it's going to break. I mean, that's the best pattern that you're going to see. Here's another, and this comes with a signal. And like I said, you don't always get these signals. There's a huge spike in volume, above average volume here, which you can pretty much see going back over the past 15 minutes to 20 minutes in the market. And up you go. Gorgeous trade. And again, extremely low risk. Not complex. I showed you this trade before. The signal down did not call the trade because, and there was no spike in volume. The spike in volume came on the actual break. So you really want to confirm that consolidation break with a volume spike. And this is really an area where you almost always get a nice spike in volume. And you can see it developing intra-candle or intra-minute as this moves up and this candle starts to form to the downside. You have plenty of time to get in. Now I showed you that same trade. Now you get a monster spike in volume right here on the break. And you get two areas up. Remember I said, depending upon your risk tolerance, come back to support, and then a potential move to the upside. Now, nobody uses volume like this. As far as I know, this is a totally unique indicator, because no matter what you're trading above, this is doing its own thing below. And you set the time interval. If you're swing trading, you may want to see a spike every 5 minutes or even every 10 minutes. If you're day trading, I think the best thing to do is to set it for every minute. Here's the break. There's the spike. Doesn't do quite exactly what we'd like it to do. It goes up, but then it swings around and goes all the way down. And I wanted to show this because I wanted to demonstrate this is going to create for you a low risk entry, but it's obviously just like every small system. It's not going to always perfectly call the break. In this particular case, you got to move back to resistance, and then everything collapsed. Here's just an awesome trade short on this huge volume spike here. And all through this price movement, you really got nothing. All through here, you just got the continuation down just on standard volume without a spike. There's your signal and the spike and a terrific move to the upside. I mean, you should be able to ride this all the way up. And again, doesn't matter whether it's 3 minute, 1 minute, 1 hour, 377 tick, 610 tick, whether it's a 13 range or a 21 range, it's all irrelevant. Now, I'll show you the offer, and then I think I have time. I go till 1:45. Okay, I have 15 minutes. I'm gonna show you a live chart, but I'll just show you the offer. Normally, each of the indicators is $2.99. You can get each individual for $139, or you can get them both for $179. You get a free lifetime license, free updates, free upgrades, and you also get a month in the live trading room, in which we have about 150 people, and they're paying $199 a month. So it's a very big discount for both indicators, plus a month in the live trading room. Now, last week in the live trading room, we made $1,750. That's right off of the NinjaTrader back end. So we usually do extremely well. We just moved to NinjaTrader 8, and we usually kill it in there. Not every day, but the majority of days we do exceedingly well. The offer expires on Sunday evening. Now let me take the slides down. Now here's our phone number. It's 786-732-4656. It's also on our website at rightlinetrading.com. Let me take the slides down. And let me switch this chart. First, let me take off all the drawing tools. And then take out the volume. And I'm going to put in the consolidation indicator. And you can see the consolidative pattern. And you can see this break of consolidation and the move up. Consolidation and the move up. Now here you're overbought, but you still get a bit of a push to the upside. You break consolidation, it's not much of a move up because you've already come all the way from here, all the way to there. Now let me just change one thing here. Chart Trader. So now I'm looking for the data series. Okay. And we can look at, there's another pattern, break, and a huge move up. Break, and another huge move up. Now, it may be very, very hard for you to see these consolidative patterns, but the software creates this, and it does this intra-candle. So after 1, 2, 3, 4, 5, 6, 7, after this candle, you're going to have the blue and the red right here. And you're going to wait for that first candle breakout, and you're going to take the trade long. Then once you get really far off the 50, you're not going to look for a continued move up. But I'm not going to trade it in a counter trend direction. I'm going to wait for it to come back down and do the same thing again. Break, and up you go. Just like that. Now, this is a 13 range. What I'm going to do is, I'm going to change, we can look at a few more. Now, here's a break, and you see that red dot? That's a short signal. And no matter where you get that, that tells you you're going to get that break to the downside. That's sort of a gimme trade, and you don't get that very often. Right there. And what I'm going to do is I'm going to put two other things in here now. To define market structure. Okay. So here's our 15 and our 50. So now we know which direction we're looking for consolidation to break. Now this breaks, comes back to support, and up you go. Here's the break straight to the downside out of consolidation. This just doesn't work. Here's the break and the move up. But this doesn't go very far. And here's your break to the downside. And here's your break to the upside. The important thing is you're almost, and look at this, this is sort of your bread and butter here. Now you're getting multiple signals in the channel. You've got a long signal. This is really unusual, but you've got a long period of sideways consolidation. You just take the break and you've got a gigantic move to the upside. Remember, these are 13-tick candles. So if you look at this move and you're in one tick above the close of this candle, maximum excursion on this trade, this is 16 and a quarter points on the NASDAQ. That's a very, very big move. And here it is again. It keeps occurring. Break and up. Break and up. Now, I'm going to put in the volume hammer. The problem with the volume hammer is that the volume hammer is running on a 1 minute. So it's not going to reflect what's going on underneath the price candles here. Because these are, the upper candles are running on a 13 range. And the volume hammer is running on a 1 minute. You can make it a 3. And you can see you're getting volume spikes, but here you just don't know where they're occurring. Because this is 1 minute,
connection,
1 minute, 2 minutes, 3 minutes, 4 minutes, and it's no longer occurring right underneath these candles. So the only way to make an assessment is to do market replay data or to actually trade the volume hammer off the right edge of the chart. And if we go to the right edge of the chart right now, you can see we got a big spike. And that's the spike that you want to see. Now this is a real time that shows you that you're going to get the bounce. Whoops, wrong thing. The bounce down in the direction of the trend. It occurs right on this candle. And because this is a tough trade to take, you have a multi-candle move up. When you hit resistance, are you going to move back down? The volume spike, which is now moving off, you can see it forming off the right edge, is going to move off this candle. And when it occurred, it confirmed the move down. Now this candle is 13 ticks. So this is about a 20 tick move. So those are the kind of things you're looking for. Now this also may have been accurate right here on the right edge. There's your breakout of consolidation right here on the volume spike. You see how it's moving away as the market continues because the candles are forming slowly and the volume hammer is moving at its 1 minute intervals. But I would be willing to bet, and it's moving further away, but there's the spike that called this move out. So you can see the combination is extremely powerful, and you just actually saw two trades evolve in real time. And what you got right here on the move down again was not a big spike in volume. This was a big spike in volume. Now, I mean, we just have to watch because that 1 minute is, the 1 minute moves pretty quickly. But you see how volume is starting to rise here on this potential continuation trade? And it's not working. But if you take a short trade here on this volume spike, you have a really good shot at getting a winner. Now, I'm going to answer any questions, and if you want to see any other markets, I'll be happy to show them to you. Now here you're getting falling volume. Let's see how it goes. See, in this market, it's just chopping. We're just not getting anything here. And just going off the right edge. Let me see if anyone would like to see any other markets, any other time frames. But this is going to remain relevant no matter what you trade. And it's going to show you very low risk, high reward entries. And you're going to take the breakout of consolidation. And the break is always defined as a 2/3 candle break above the upper trend line. And I'll just change it real quickly to a 3 minute. Let me remove all the drawing tools here. See, now here consolidation's a little bit rarer, but it calls this huge move to the downside. That's a breakout of consolidation. And the fact that it made this big run is no accident. Here's this move out of consolidation. And the fact that it made this big run to the upside is no accident either. There's your trade to the downside. And this is one that just does not go anywhere. Look at that break to the upside out of consolidation. Here, there's no break. There's no candle that ever breaks consolidation here to the downside. No break here. Just have multiple channels. Here's your break and your move down. Unfortunately, we can't look at the volume hammer because there's the break and the move down. Now this is a monster trade, and we would have to configure this for you on time, but here's the break of consolidation right here, and the move down. So let me quickly go take a look. Well, I'm right at 145. Give me 60 seconds. I want to look at any questions, and I really appreciate it. Your time. Hang on 1 second here. There's no threshold, Wayne. You just want to see a significant move above average volume. That's all. And so there is no threshold. The contact information, I'll show it to you right here. I'll leave it up right here. Because key, there can be two areas of consolidation that form on top of each other. And those are even more powerful areas to trade. I'm sorry, this is the wrong number. It's 723. I'm sorry. And then I'll be out of here in 30 seconds. I don't want to hold everyone up. 732. It's 4656. That's our number. You take the trade on the 2/3 candle close of the upper and lower consolidative pattern. Mohammed, I'll show it to you if you want me to, but you're going to have to call me because I just don't have time, and I've already taken up an extra minute. I just don't have time to move it back to the E-mini. Trust me, it works. The consolidation pattern and the volume spike work on any market, on any time frame. They're forces that move price that are independent of the instrument. They work on the Forex, stocks, and the E-mini. Makes no difference at all. So thank you so much for your time. I really appreciate you guys for allowing me to present. And I hope to see you in the trading room because in addition to the indicators, you're going to come in for a month, and I think you're going to be really impressed with how well we do. We do exceedingly well in there. Take care, everyone, and have a really, really wonderful day. And I wish you all the best of luck. Bye-bye all.